So I'm going to hit some highlights. Paul Raculia and Jance Pierce are going to help with some of the investment discussion. And also we have from Country Club Trust, Susie Hall, who's the president of the trust company, and Doug Hacker, who helps with the CFNEK relationship as well. I'll talk about what happened in the quarter. I'll talk about what's happened subsequent to the quarter, which quite a bit has happened subsequent to the quarter as well. And then I'll include in that a piece of information that some of you may be aware of from last week. So the quarter ended March 31st. It was a rough quarter for equities, particularly in March. We were a little bit behind in the equity fund for the quarter, not quite 60 basis points under the benchmark. Some of the dynamics that led to that in particular were, it was a juxtaposition, I would say, in regard to international stocks versus domestic stocks. As some of you may recall, for seemed like ages, domestic stocks outpaced their international cousins and brothers and sisters. But during the first quarter, international stocks were up about 5% overall, and domestic stocks, when you look at the Russell 3000, which is part of our benchmark, were down close to 5%. And traditionally in this portfolio, we've been underweighted international stocks, which has been to our benefit for quite some time. But certainly that was a headwind for the quarter. So that I would say was the predominant reason for the underperformance. Paul will talk about some of the things we've done during the quarter and subsequent to that in regard to some of that portfolio construction. But that was the reason for that. Also, the Magnificent Seven underperformed dramatically for the quarter. That has been a tailwind in a lot of aspects for quite some time, but that area lagged significantly. And so you had a situation where growth stocks were down about 2% for the quarter, while value stocks, which the Magnificent Seven are not a part of the value portfolio or value index, more of the growth segment. Value was up about 2 and growth was down close to 10. So really some interesting situations during the course of the quarter. In regard to USCCB compliance, we have consistently been in good shape there. As you may recall, the mandate is to be at least 97% compliant, and we ended the quarter at 97.3% compliant. In regard to fixed income, it was a strong quarter for fixed income, as you see there, with the portfolio up 2.25%, just slightly behind the index. Our duration was in the 3.5-year area versus 3.7-ish for the index. Chance will talk a little bit about this in a moment, but we're currently at about 3.6 years. So we're getting closer and closer to that index duration level. Historically, we've been considerably below, but with interest rates being higher and the prospects of interest rates going lower at some point, depending on some Fed decisions upcoming and through the next several months, we think interest rates could go lower. So we're pretty much going to be neutral, I think, on our duration for quite some time. And in regard to the hypothetical portfolio, we put that in as an example because I think a lot of folks are at a 60-40-ish level, 60% in stocks and 40% in fixed income, and just give you an idea of what the portfolio would look like in that regard, performance-wise. So that portfolio would be down probably about 0.5% for the quarter versus more or less flat for the relative index. And the blend for that USCCB compliance would be probably about 98.5%. So again, significantly above the 97% goal, with fixed income portfolio really being at just a tad, I would say, under 100% compliance. So any initial questions I might be able to answer on the performance page? I'll touch on what's happened in April and May quickly before I bring in Paul to talk about some of the construction items on the equity fund. Okay. So for April, just so you know, and in May, April, even with all the gyrations with tariffs, et cetera, the equity portfolio was up about a quarter of a percent or so. And not a lot, but if that if the month ended on April 15th, there would have been a much different and much more negative outcome. So thankfully, the last couple of weeks-ish of the month were good. So far in May, we're up about a percent and a quarter, percent and a half, something like that, which is good. So the hole we dug in the first quarter of down, let's call it 2.5%, we've actually made up a percent and a half to percent and three quarters of that or so. So hopefully we'll be back to level par before
But
too
there's
long.
our insurance
In
information,
April,
but then it's
the
prescription
fixed income portfolio was up about 85 or 90 basis points so far. In May, it's down about 40 basis points. So year to date, it's up, well, let's say two and three quarters for the first 4 months plus of the year. So that fund in particular is in pretty good shape from a relative standpoint and also from a nominal standpoint. So, any quick questions I could answer in regard to performance? And if you have some at the end, we'll certainly take some time there as well. Let's see if I can get this. Paul, I'm going to pull up the construction of the equity fund. So if you want to maybe make some comments on some of the moves we've made and maybe some differences between the end of the year, end of the quarter, and subsequent, that'd be great.
Sure. Yeah, happy to, Chuck, and hello, everyone. For the quarter, I'd kind of describe the moves in kind of two buckets. One, we increased what we would deem the quality of the portfolio a bit. We reduced kind of our domestic small cap exposure, added to our domestic mid cap, which tends to be kind of a higher quality company typically. So that was one, what I call kind of a portfolio move. The second bucket would be more rebalancing that occurred throughout the quarter and beyond. So we get generally instructions at the end of the month about rebalancing from equities to fixed or vice versa. Given the market volatility, we actually added to equities during the quarter, and we took the opportunity to kind of reposition the portfolio a bit when we did that rebalancing. So as Chuck described, we had been overweight the US, particularly the large cap space, for a long time. With the recent moves in the market, we took the opportunity to add more to the international side of the portfolio. With the net result being we went from having a decent underweight to international to being slightly overweight on the developed market part of the international portfolio. So if you looked at the weights at the end of the year, if you look at this slide here, we were 69% domestic large cap. Today, round numbers are around 67%. On the international developed side, we went from 18 to 19. So I'd say those were probably the bigger moves for the quarter. And then beyond, again, we got some rebalancing instructions at the end of April. So we kind of continued that process to get us more in line kind of with where we want to be position-wise against the benchmark. So I'll leave it there to see if there's any questions now, or maybe we can circle back to them later.
Thanks, Paul.
Sure.
On the international side, the one area we still are underweight is emerging markets, right, Paul? I mean, developed is more neutral to overweight, but the emerging markets were still a little bit underweight, I think.
Correct. Yeah, we don't show the benchmark here, but if you were looking at the benchmark, we're about 160 or 1.6% underweight versus emerging market and plus 30 basis points on the international developed side.
Any questions on the construction of the equity fund, at least at this point? Chance, you want to chat a little bit about fixed income construction?
Sure, Chuck. Yeah, so kind of the same thing on the fixed income side. Really, as Chuck mentioned earlier, we've been moving duration. I mean, we were below two from a duration standpoint in 2019, pre-COVID. And then over time, at this point, we're at about 3.6, 3.7%, which is neutral with the benchmark. So that's one of the things we've been doing over time is increasing duration. Another thing that we've been doing, if you look at credit spreads, meaning
He's
how much,
talking.
I'm sorry. Oh,
Go ahead, Chance. I think there's
okay,
just
sorry. If you
fine.
look at credit spreads, meaning how much, we're being compensated to take extra risk in the fixed income market, those spreads have been extremely tight. On the investment grade side, they've been under 1% since the end of 2023. So we went from about 50% Treasury and agency or government bonds at the end of 2023 to now we're about 65%. Um, so, the fact that we're just not getting compensated for taking that extra risk, we've decided to just, park some of the more money in treasuries, which, theoretically are risk-free. So we've moved we moved about 3.5% in the first quarter and a little bit more here in the second quarter through different rebalance as we've gotten cash from rebalancing activities. But so really the two main things we've been increasing duration to get closer to that benchmark duration, and then also due to where credit spreads are, we've increased our allocation to treasuries over the last year or so. So.
And I think our focus when in adding the duration is we've used the 10-year and its yield as our focal point. When the 10-year has hit, what, 4.5%
Yeah,
ish,
yeah,
we've
we
used that as kind of a spot to, gravitate. Is that right, Chance?
yeah, more recently it was 4.4. It hit 4.4 very briefly there in mid-May, early to mid-May, and uh, we were a little more aggressive than what we have been increasing duration on that day, actually.
Any questions out there for portfolio construction of the fixed income fund? All right, I'm just gonna make a couple of comments about kind of the macro environment. Invite any questions you may have on that side or on that front. So certainly tariffs have been the number one news item for the last couple of months or so. Obviously, in April, after the Liberation Day announcements, the market had a lot of volatility on the and market being not only the equity market but also the fixed income market. Tremendous volatility, and things settled down a bit after I would say mid-month or so, and the markets have um, and on the equity, both of them have settled down quite a bit. Equities actually ended the month in pretty decent shape versus, where they had been, and interest rate levels, bond prices, et cetera, stabilized, I would say as well. But certainly that's still a major item. I would say the market is digesting them in a way that tilts heavily towards the growth aspects or potential impediments of the tariffs rather than inflation. Inflation is still, a question mark in regard to a lot of factors, including the tariffs. But we think that the major impact that the market is trying to digest is how tariffs um, uh, create some difficulties on earnings and growth. And you see different parts of the market that signal that concern more than inflation per se, at least at this point. And in conjunction with that, I would say consumer confidence is a major factor as well. Certainly the ability to for all of us to spend money on products and services is a large portion of our economy, and consumer confidence levels have been declining over a little bit of a period now, and so that is certainly a concern. But even with consumer confidence surveys being matriculating towards the downside, I think most of us have still opened our wallets and provided some positive aspects to the economy, even though the first quarter GDP was down a hair. There were some idiosyncrasies within that calculation that are a little, maybe are a little concerning, but not as much as they would be, if those idiosyncrasies weren't involved. Um, so those are the things kind of at the macro level that we're looking at. Um, and I think I'll open up for general questions in a moment, but I just want to bring up the fact that most of you probably have seen that Country Club Bank and obviously Country Club Trust Company as part of Country Club Bank is engaged and has will be merging with FNBO, First National Bank of Omaha, later this year, if not the beginning of next year. That was announced internally on the 30th, last Wednesday, and publicly on the 1st of May, last Thursday. So I'm definitely happy to answer any questions on that front. We are, the wealth management piece of uh, Country Club is a big portion of the Country Club Bank equation, and it's certainly a big part of FMBO as well. And we are looking forward to our engagement with that group. I've actually had some engagement with my counterpart there for a few months, and definitely have some insights there that I'm able to share if anybody is interested. Don't want to hide from that. So I'm throwing that out for potential discussion as well. So I'll just pause, Bill and everybody, and certainly happy to answer any questions that anybody has on the economic front, the portfolio front, or the Country Club Bank front.
So
So
any
if you, ahead, John.
so any I guess do you guys blend in pretty well with their work? Are there any changes in personnel or what's going on with that in that regard?
Yeah, that's a good question. So the messaging that we've gotten from them, and it's been, I would say, side by side discussions. It's, given the, FNBO is a lot bigger than us, John, but still, we're not in a situation where we're getting, gobbled up by a behemoth. So there have been a lot of discussions. So the direct messaging has been that, they're very happy with Country Club Trust Company, the services that we provide, the performance that we've been able to provide to our clients, and also honestly the financial performance that we've been able to provide to our parent company. And so what we've been told multiple times that there is no anticipation of any personnel cuts within the trust company. So I've gotten to know these folks over the last 4 months or so. I'm taking them at their word. They seem to be good folks, not only within their wealth division, but also throughout the organization. And so they have told us this many times over the last few months, including just over the last week, that there are no anticipated changes to personnel, within the trust company, and that what they're thinking is that there'll be a wealth management hub in Omaha, and there'll be a second one here in Kansas City, and that they're looking to grow our presence in Kansas City, honestly, which is good to hear. What any organization likes to hear, a growth pattern, and that's what their goal is, to have us grow Kansas City's footprint in regard to wealth management. We're pretty we're significantly smaller, I would say, than the Omaha piece, everyone, but still a significant portion of the total wealth management equation for what will be the combined company.
Looks like a great match. Wish you guys the best and keep doing what you're doing.
Thank you. I appreciate that. Other questions? Please, I know I say this every time. Please don't be bashful. Happy to answer any questions that anyone may have.
Wow.
All right.
No questions so far. Go ahead. Go ahead, Gary.
On the international side, we pay attention to that USCC be a compliance, and I'm curious if it poses any more challenge to have that monitored for the international portfolio side versus the domestic stuff.
Yeah, that's a good question, Gary. Paul, maybe I'll start, and I'll I'll hand it off to you a little bit too. So it's, percentage wise, it's been a challenge, but what about a year and a half ago, we started utilizing a U.S. Trust SMA that we dovetail with to make sure it's 100% compliant. And that has helped out a lot. The performance has been competitive as well, and the fee level has been also. So I think that's helped us quite a bit. Paul, and I know I've probably taken a little of your thunder, and I apologize, but I'll let you opine as well.
Yeah, no, I think what you said is exactly right, Chuck. I think from a monitoring standpoint, it really doesn't present any additional challenges for us. I mean, we use an outside tool for that, and really to the degree the data is available on the underlying companies, that provider captures all of that like they do for domestic. So for us, we get at the fund level non-compliance percentages on all those international pieces, just like we do the domestic. And as Chuck says, in the kind of broad-based indices, those are some relatively high non-compliance percentages, and that's why we went down the road of finding that 100% compliant solution. But from a monitoring standpoint, it's really very consistent with what we're doing on the domestic side.
Yeah, because is a percentage like on the generic, the IFA, like it's north of 15%, right, Paul? I mean, considerably north of
Yeah, it's I'm looking at 331, it was close to
18%.
19%.
Yeah.
So as Chuck said, that presented a challenge for us, but fortunately there's solutions out there, and First Trust is the solution we're utilizing, and the performance so far has been pretty good, and 100% compliant solution at that. So
That's helped a lot, actually.
yeah.
It's a good question. Thanks, Gary.
Yep.
Any other questions? I know we're getting close to the bottom of the hour, but happy to answer any quick questions you have. And if there are any that come up, Bill, and from anyone subsequent to the call, I'm certainly happy to respond to them as well.
Yep. And just so those of you that are fund holders, uh, you can submit a rebalancing of your portfolio between our equity, fixed income, and money market options. So we do handle those monthly. So that is available to you. We do rebalance if you get out of whack with what you've elected as well. So we do that at least quarterly rebalance. So we take care of that part for you. But if you ever want to change your allocation, please reach out to your fund steward, and they'll be glad to get you the proper documentation. You can also find that at CFNEK.org. You'll be able to find the documents to make those changes. So want to remind you that is available to do. We don't do that. It's not daily, so it's not like your brokerage account or 401k daily type of thing, but it's a monthly setup with us. So I just want to put that reminder out there. Any other questions? And yeah, we'll be glad to put you in touch if you want to just submit them to me or any of us here at the foundation. We'll be glad to pass those questions on and get Chuck or a member of his team in touch with you to answer those. They're also always willing to come out to your organization to discuss the questions you may have as well. So
anytime.
Appreciate it.
Thank you all for
Chuck
today's insight.
Go ahead, Steve.
Thank you all for today's insight.
Oh, you're welcome. Thank you.
Any other questions before we go? All right. Well, thank you, Chuck and team.
Thank you all.
We'll continue to do these on a quarterly basis, and we hope it's insightful for both your charitable dollars as well as any personal insights you get there as well. So thank you, and pray for those Cardinals, not the St. Louis Cardinals, by the way.
They might need some prayers too. They're not playing very
they
well.
might, but I don't. I'm gonna go. I'm gonna get myself in trouble if I keep talking. So anyway, all right. We'll see you all. Thanks for joining us.
Thanks, everyone.